Here, I'm Katie Mollering. I'm the Adult Services Librarian here at Emmett O'Neal Library. I know most of you have joined us before. So tonight we're going to talk about stocks and bonds. And I also wanted to point out, next Thursday evening, we're going to have a special program on saving for college. So we'll talk about options for students to take advantage of, like grants, scholarships, and loans. And we're also going to talk about prepaid college plans and other ways that you can save for college. So I hope you'll join us. We'll have pizza. If you have a teenager, bring your teenager. I think we'll learn a lot. Also, don't forget that the programs that Dr. Radricus has been giving all year are found on the website. And there's a Smart Investing banner. You click on it, and it will take you to all of the programs we've done so far, as well as the list of the programs that we'll have in March, April, and May. One other thing, the new brochure you have in front of you is really focused on the spring programs, and the Dolores Hydock finale that we were planning for May 17th has been moved to May 10th, and that's reflected on your new brochure. So I just wanted you to be aware. If you're looking forward to that, it'll be a great program. We just bumped it up a week. Okay? I am going to turn over the stage to Dr. Radricus to tell us about stocks and bonds.
All right, well, thank you, Katie, and thank you, everybody, for coming. As always, Katie is a lot more optimistic about my ability to dispense information than I am. But, yeah. But anyway, I'm glad you all could come tonight. Going to have a lot of information tonight. There's a lot of things that we will talk about when it comes to stocks and bonds. We obviously had our program on mutual funds last time, and as I said in there, that for most of us, that's all we ever need. Now, what we learn about tonight is what are these different kind of stocks and bonds, and what are they, what are the risks, how do I pick one, and so on and so forth. And for most of us, that is probably a lot more than we ever want to do. But maybe you find out something that you didn't know, or something that you might be interested in doing moving forward. I think this computer is very slow because it's moving very slowly. Well, the next slide that you're going to see is the usual one, that I do not give any advice. That I'm not a financial advisor, and all of that. Somehow it went out back to this. Let's try this again. This computer seems to have some issues.
Let me go grab the other one, and we'll just swap out. So if you want to get started.
Okay, that's fine. I mean, everybody has the slides in front of them. There you go. So again, I'm not an investment advisor, broker dealer. I don't do any of these things for a living. So anything that you hear in here is purely for informational purposes, and I'm not telling you to buy or sell anything. Now, what are stocks and bonds? How do we pick them? What are the risks? Well, let's start with the stocks. Now, in theory, when you buy stock, you actually become an owner of that company in which you buy stock. Now, that sounds a lot better than it actually is, because most companies have millions of shares of stock outstanding. If you own one or two of them, that doesn't really give you much of an ownership stake, but you are officially an owner of the company. And as such, you're entitled to certain things, like go to a shareholders meeting and vote. Now, there are things that are voted on in a shareholders meeting. So you're entitled to go to a shareholders meeting. One share of stock is enough to be entitled to go there. If it's a company that's nearby, it might be worth to just check it out. It might not necessarily be worth to travel around the country unless you're really interested in what they have to say. Most of these are fairly boring unless the company is in trouble. And the company is in trouble, and there's a lot of disgruntled shareholders. These things actually could be quite entertaining because everybody has a voice too. In other words, everybody has the right to speak at those meetings too. Remember, you are an equal owner equal with every other shareholder. You might not have as many shares, meaning you don't have as many votes. Basically what happens is every share carries one vote. So if there's 100 million shares outstanding for a company, one share carries one vote. Unless you have 50 million of those, obviously you don't have much of a controlling power there. However, what happens is that not all the shareholders go to shareholders meetings. Most actually do not. And when we have companies where the shares are fairly widely spread, so there's lots and lots of different shareholders, normally an ownership of about 5%, 5 to 10% already gives you controlling ownership of a company. Because a lot of people, what happens is when you own stock, you're going to get an invitation to the shareholders meeting, you're going to get something in there that's called a proxy statement, where you're asked to fill it out. If you do not want to go and vote your own stock, you can give somebody the authority to do it for you. And if you don't do that, most people just take this proxy statement and throw it away, then those shares will never be voted. So there might be 100 million shares outstanding, but only 40 million of those shares actually vote, and the other 60 don't ever do anything. And what you vote on is a board of directors, and the board of directors are the ones that hire and fire the management. Now that's effectively what you vote for, and there's some other things, like if the company were to be taken over, you would have to approve something like that. If somebody wanted to buy, if the company wanted to merge with another company, some major decisions that have a major impact on the company's setup, the shareholders normally have to be asked. That depends on the company. They do have a corporate charter and they have bylaws, and it will say there exactly in there what the shareholders need to vote on and what they don't get to vote on. But as a general investor, that's really very little of your concern. You're really just looking at those as an investment, and not so much as I want to be an owner of this company and really make company policy. Preferred stock does not carry a voting right, but receives a fixed dividend. Preferred stockholders have a precedence and claim over common stockholders. That's why they're called preferred. So when a company cannot pay dividends because of their earnings situation, then as a preferred shareholder, you're also not going to get a dividend, even though it's promised to you, but it's not guaranteed. However, they can never pay another dividend to a common shareholder before they make up all the dividends that they're owed to the preferred shareholders. That's the way this works. The stock price is what you're going to have to pay for it. Again, the dividends are a distribution of the company's profit, so they're normally paid on the company's net income. And they're going to decide how much of the net income they're going to pay out to the shareholders and how much of they're going to keep. Dividend policy is made by the board of directors, not by the management. Now, for the vast majority of US companies, the chairman of the board of directors is also the CEO of the company. There's nothing illegal with that. With us in the academic field have a major problem with that, but because it's not in what the law intended. When it created a board of directors, that the CEO ends up being its own supervisor. That kind of, or her own supervisor, because that's what effectively happens. The board of directors is supposed to monitor the management. So if the chairman of the board is also the CEO, then the chairman of the board monitors him or herself. So that is not particularly an efficient system. But the dividends are declared by the board of directors, not by management. It's very important to understand. The board of directors makes the decision. They will tell you how much you're going to get per share, and that's normally paid quarterly. Dividends are paid on a quarterly basis. You don't have to worry about getting them. If they are declared, they're going to be sent to you. And what's going to happen is they're going to be sent to your broker, and then they're going to go from your broker to you. Your broker is going to put them in your account. Dividend income has to be taxed. There you go. What kind of stocks do we have? Now, there's a whole bunch of different stocks in terms of what kind of stock there is. Not so much what kind of industries or companies, but what kind of stock. A growth stock, for example, is a stock of a company that's growing very quickly. Has very high growth rates in sales. It's normally a company that is new. A new company in a new industry, when they have double-digit growth rates, 10, 15, 20%. That's a growth stock. What you will see with those stocks that they're very volatile in their price, and the company doesn't actually grow at a high rate. They're going to go up very quickly, but the first time there's any kind of slowdown in the growth, you will see a very swift impact on the stock price. Now, blue chips, those are our company that everybody knows. The large company that's shown over a long period of time that they can withstand any kind of business cycle. The Procter & Gamble's of the world, the Gillette's of the world, those kind of, the Exxon Mobil's of the world. Those are the kind of companies that we think about. Now, sometimes blue chips turn into something less than a blue chip, like GM, for example. GM was considered a blue chip at some point. Probably nobody's going to look at them as a blue chip at this point. But you're looking at the large companies that over a long period of time have proven to us that they are good companies and that they can withstand bad economic cycles and still pay a dividend. Most of these blue chip companies you will actually find in the Dow Jones Index. So if you look at the Dow Jones Stock Index, most of the companies that you find in there, there's 30 of them in there, you would consider blue chips. And those are very safe investments for the most part. Again, sometimes they fall from grace. GM is one example. Sometimes things just change. Kodak, Eastman Kodak declared bankruptcy just a few weeks ago. Now, who would have ever thought that? Who would have thought 20 years ago that Eastman Kodak would ever file bankruptcy? See, now we're all going to have our Kodak moments without Kodak actually being around. And it's a typical example of a company that just missed the boat. They just didn't see somehow they missed that whole digital photography thing, and they just couldn't keep up with the future. And that's basically what happened to them. Cyclical income stocks are stocks that pay a high dividend. So those are stocks that provide you with a steady income. And the income that you get with stocks, again, are stocks that pay dividends. Utilities are a good example, like Southern Company. Those are companies that pay a very steady and fairly high dividend every quarter. So they are good for, if you need a steady income, they're good in income. They do not grow much in price. The stock price does not move much, but they pay a good steady dividend. And there are different tax situations. I don't want to get into this, but sometimes dividend income is taxed differently from interest income. So you can say, why not just buy a bond, something we can talk about later, to get an income? You can, but you're being taxed differently between those two. And there was a time just a few years ago where we had a year actually where dividend income was not taxed at all. So in that particular case, it actually made sense to have dividend rather than interest income. Cyclical stocks are stocks that move with the business cycle and move with the economic cycle. So they're going to be really good when the economy is good, and they're going to be really bad when the economy is bad. So those are the kind of industries that directly react to what happens in the economy. Defensive stocks are the exact opposite. Defensive stocks are stocks that pretty much don't do much one way or the other, where the earnings are very steady, and again, they pay a high dividend. So a lot of income stocks are also defensive stocks. You could look at it the same way, and a utility stock would be considered a defensive stock because they pay a very good dividend, and business cycles and economic cycles don't make a difference. Because if I'm Southern Company, regardless of the economy, people are going to turn on the lights, they're going to turn off the lights, they're going to turn on the heat, and they're going to turn on the gas, and they're going to turn on the air conditioning. I mean, these things are going to happen regardless. Maybe I scale back a little bit, but generally I'm still going to do this. So I don't see much of a difference in the sales and in the performance of that company, regardless of the economic cycle. Again, because of that, these stocks will not generate a very high return for you. It's always the trade-off. The riskier an investment, the higher is going to be your earnings potential on it. If I have a defensive stock, then I don't want risk. That's why I buy that. So I'm not going to see a lot of increase in value in those either. Value stocks. Those are probably the most difficult ones to find. Those are the ones where I believe that the stock is undervalued. Meaning I do an analysis of the company, and I come up with a number, what I think is the true value of at which the stock should be trading. And then I look up what the actual market price of the stock is, and I see that that market price is less than what I think the stock price should be, I should buy that stock. So those are stocks where I believe that they're undervalued, where they are actually going to go up in price, and I'm pretty sure that they will, because the company's performance is much better than what the stock price indicates. Those are the value stocks. Those are the ones that everybody's looking for. And they're the most difficult ones to find. Because if that was easy to do, everybody could make a lot of money in the stock market. Because that's the best one. If I find the value stock, if I find a stock that I think is undervalued, and in that in itself means that you believe that you know something that the rest of the market does not know. Because the stock price represents what everybody else believes is the value of the stock. You think the value of that stock is higher, meaning that your analysis is somehow superior to everybody else's analysis, as it could be. Or you might just be the only person looking at the company. No, you're looking at these diamonds in the rough here. Companies that don't get a lot of press, that people really don't know about. And those are the ones where you can still make some money and find some value. You're not going to find value in a Procter & Gamble. That's not a value stock. That's a very well-performing stock, don't get me wrong. There's a good dividend and the company is doing very well. But it's not a value stock. It's not an undervalued company, because everybody knows them, and there's about 500 analysts that follow that stock on a daily basis and write about it. So everybody knows everything about that company. But if you have a company that is a small regional company that's just gone public and has stock traded at an exchange that nobody really knows about except for the people that live in that region or do business with that company, that might be a company that is not really recognized for its true value in the market, and there's some potential. Speculative stocks you really don't want to deal with to begin with. They are, as the name indicates, speculative, so it's effectively gambling. We're talking penny stocks. We're talking stocks that are trading at 5 cents a share. And if they go up to 10 cents, you double your money. But there is a reason why they're trading at 5 cents a share. They're not trading at 5 cents a share so that you can make double your money within a week. They're trading at 5 cents a share because the company, that's what the company is worth, 5 cents a share. So they're very speculative. Or you could invest in a company that does oil exploration or gold exploration. They're gonna issue stock in order to finance their pursuits. So they might go somewhere, to northern Canada or Alaska and look for gold. If they find it, that company is going to make a lot of money, and as a shareholder, you're going to make a lot of money. If they don't find it, they're just going to fold and you lose your investment. That's a speculative stock. Most of those stocks you're not going to find necessarily traded at the New York Stock. You will not find traded at the New York Stock Exchange. You might find some of those on the NASDAQ. Most of these are going to be traded at stock exchanges where the listing requirements are lower. Like if you wanted to actually invest in a company that's looking for gold all over the world, or gas or oil, the Vancouver Stock Exchange is your stock exchange. That's where these stocks are traded. And you can buy it, but it's gambling. There's nothing other to it than gambling. So these are very highly speculative, or biochemical companies that basically where the fortune of that company depends on some patent that's going to be approved by the FDA. If that actually happens, you're going to make a fortune. But if it does not happen, then you're going to lose your money, or at least not all of it, but you're going to be in some bad situation. That's a speculative stock. As an investment vehicle, you want to stay away from those. If you like to take some risks in there with extra money that you have that you don't need for anything else, for retirement or any other savings purposes, go ahead and do it. But you should never have those in any kind of serious investment portfolio. Because whenever it says the word speculative in it, it's not an investment. Investments are not speculative. Okay, what do I need to know? Well, as with everything else, you need to be able to find the right information, and then even more importantly, you know how to interpret it. And that's where it gets difficult. That's why I mentioned when we talked about mutual funds. With mutual funds, the people that run the funds are the ones that know how to find the information and they know how to interpret it, because that's their job and they're trained to do that. Most of us either don't have the training or the time or both to do all this, because that's very time intensive. And we'll talk about later about the do's and don'ts of stock investment. And there's a lot of things on the don'ts that unfortunately a lot of people do. You need to invest for growth and value. That's what you're looking for. If you want to actually increase the value of your portfolio, if a long-term investment, you invest for growth and value. So you want to find a company that grows. The only way that the stock price of the company can ever go up is if the company actually increases its sales every year. If I don't have a company that grows, then there's no reason for the stock price to go up. Because the stock price is a reflection of the value of the firm. The value of the firm can only increase if the company does better every year. If the company does not grow, your stock price is not going to grow. And again, looking for value, looking at what the company is doing, and kind of figuring out, is that a good value? Is this a good company to invest in? One of the major things is, do I understand the product that they sell? One thing that Warren Buffett will tell you is that he's never invested in a company whose product he does not understand. And that's a very good rule. If I invest in a company of which I have no idea what it is that they do, how am I ever able to actually have any kind of idea if that company can be successful or not? And I remember listening to a talk by the chief analyst of JP Morgan for pharmaceuticals. The chief analyst, equity analyst for JP Morgan is an MD. He does not have a finance degree. He is an actual doctor, an actual physician. And he also had a PhD in bioscience from UAB, and that's why he came talk to us. But those are his degrees. His degrees are all in science. But he understands what pharmaceutical companies do. He understands the drugs. He understands the products that they do their research on. He can look at the clinical trials, and he has some idea if there's any merit to what they're telling you. I cannot look at the report of a clinical trial and tell you if this makes any sense or not, because I don't have that knowledge. I can crunch the numbers for you, but I don't understand how the product works in the way that I can understand, yes, this sounds like a good drug, or this sounds like a bad drug. I don't know. I have no idea. So that's why you see that a lot of times that, in particular, very specialized industries, the people that actually analyze those industries for the large investment firms are people that have degrees in those fields, and they do not have finance degrees. What you're looking for, earnings per share, price-earnings ratio, there's a whole bunch of different things to look at. Earnings per share is just how many dollars per share did the company generate. It's just the net income divided by the number of shares outstanding. Price-earnings ratio is, as the name indicates, the price of the stock divided by the earnings per share. Now what this is telling you is how the market values the company's earnings. The larger a price-earnings ratio, the more the market expects from that company in the future. Because the stock market is one thing, and that is an oracle for the future. The stock market does not care what happens today. The stock market surely does not care at all what happened yesterday. The stock market is only worried about and cares about what happens in the near, intermediate, and long future. That's all they're worried about. That's when you see the Dow Jones and the S&P going up like crazy in the last few months. Now we're back to the 2008 levels in the stock market. It's not because we're doing so great right now. It is because the stock market expects things to be great going forward. That's what the stock market is. Stock market is not the economy. Those are two very different things. Stock markets are all about expectations. Once I get, what can you do to, what have you done for me lately? That's what the stock market is. They don't care what you did yesterday. They don't care what you do today. They give you value based on what they think you can or should be doing tomorrow. And that's what the price-earnings ratio tells you. The higher price-earnings ratio means that the stock market expects a lot from you. If you do not meet those expectations, then your stock price is going to drop. Meaning that a stock with a very high price-earnings ratio is a stock that is very risky, can be very volatile. Also cannot be a value stock. A value stock cannot have a high price-earnings ratio because A stock that has a price that is low relative to its earnings is a stock where the market does not either believe that the earnings are sustainable or they don't really know what to do with it. So if you're looking for a value stock, it will always be a stock with a low price earnings ratio. However, low price earnings ratio might also mean that the company is just not doing very well. That's why it is not that easy. It's not like, okay, why not just go for all the stocks with a price earnings ratio of 3 and those got to be the value stocks. Unfortunately, again, it's not that easy. If it were that easy, there were a lot of people that could make a lot more money in the stock market. And then again, if it was that easy, then actually nobody could make any money in the stock market because everybody would be doing it. That's why I always say, when somebody gives you investment advice, where they say, this is the no-miss investment, and if you invest in this, you're going to make a fortune. You always have to ask yourself, why are they telling you that? Because the more people know about it, the smaller is going to be the fortune that somebody is going to make out of this investment. Now that's always it. Somebody who gives you investment tips for free, you always have to wonder why they're giving you free advice, because they can make money off of that. If their tips are so good, and if they do it, especially on television, they cannot buy the stock first and then tell you to buy it. That's against the law. You cannot do that. It's called front running. You're not allowed to do that. Like Kramer on CNBC, the crazy guy that always yells. Not the one from Seinfeld, but the other one. And he gives you advice. He cannot act on his own advice, not until after he told you about it. He cannot buy company A today and then tell you tomorrow on his show, buy company A. If he does that, he'll be off the air the day after that, because that's illegal. You can go to jail for that. So you cannot do that. So whoever tells you something like that, again, you always have to think about the fact that if they really got that great an idea, why are they all sharing it with you? Because that makes the piece of the pie just smaller and smaller and smaller. Unless they're really idealistic and just want to share the wealth with everybody. However, I have to tell you, most people that in this industry do not want to share the wealth with everybody. They're kind of, everybody's out for their own. The whole idea of economics is to maximize your personal utility, which is, personal wealth. That's the whole idea behind economics, is maximizing your personal wealth. So most people in this industry are not in there to make everybody happy. Now dividend yield is what dividend the company pays relative to its stock price. So if a company pays a $1 dividend and it's a $10 stock price, that means the dividend yield is 10%. So what is the dividend relative to the stock price? Dividend yields are normally very, very low. 1, 2, 3% is the most you're going to get as a dividend yield. Now 3% dividend yield is actually very good dividend yield for stock. Mostly dividend yields are much, much more, less than 1%. Book value. That is the actual value of the equity in the balance sheet. Not really that important unless you compare it to the market value of the stock, and then you can see if the company has actually created value for its shareholders. See, in accounting, you need to put the value of your stock in your balance sheet, whatever the value was when you sold the stock. That's the book value. Now, once it's sold, every time you buy the stock or sell the stock, the company has no benefit from that in terms of getting money or anything. That's a secondary market transaction. You buy it from somebody else who owns the stock. You're not getting it from the company. But the value of the company goes up, because if you wanted to buy the company, what you would have to buy is all the stock, all the shares outstanding. So the more the price goes up, the more valuable the company is. So if you compare what the stock value was when the stock was issued and what it's worth now in the market, then you can see the company created value. If it is higher, the market value is higher than the book value, you know the company created value for its shareholders. If the market value is less than the book value, that means the company has destroyed shareholders' value over time. Meaning that if you had been an investor in the company when it first issued stock, you would have lost money. You don't necessarily want to invest in companies that do that. Again, there are certain situations where the company might have just been in a turnaround, and then it might make sense. So you can never have like a fast rule, fixed rule in stock investing where say, if this happens, you need to buy or you need to sell. Unfortunately, it doesn't work that way. Return on equity is how much does the company return on using the equity that it has. So it's net income generated by the company divided by the total equity that the company has. Debt equity ratio, how much debt does the company have relative to equity? In other words, how much debt is there per dollar in equity? The higher that debt equity ratio, the more debt the company has, meaning the riskier it is from a shareholder's point of view. Because from a shareholder's point of view, all you have, apart from the voting right that I talked about, is a residual claim. Meaning you have a residual claim on the company's cash flows, which means nothing other than you only get what's left over after everybody else, and I mean literally, everybody else got their money. If then there's something left over, that goes to the shareholders. If a company goes bankrupt, there is normally nothing left over for the shareholders. So you've got to be very careful when a company has a lot of debt that makes the company risky from a shareholder's point of view. Because you only get what's left over. The more people get a piece of the pie of the company, the less is left over for the shareholders. And then price volatility is just how much does the stock price vary over time. You know, how much can your stomach take? Can your stomach take a stock price that goes up 3% one day and down 2% the next day, and then 3% up the day after that, and then 5% down the next day? And there are stocks like that out there. And especially right now, some companies have been really hit by this. There are certain traders in the market that trade or make money off of volatility that increase all this. Companies like Regions stock has been going like this for the last 4 years. It's effectively going like this. Or, I mean, every day that stock goes up 2 or goes down 2%. And you know, as a shareholder, you cannot like that, and the company certainly doesn't like it either. But they cannot do much about this. Now, where do I get? Now, this is a very small. There's a lot of information on here. Where do I get the information? Now, some of the things they actually have in the library here. Now, some of the things you can get online. Obviously, number one information would be the company's annual report. And you can get the company's annual report normally on their website, or you can ask them for it. You can call them, and they will send it to you. They have investor relations divisions, and they will send you an annual report if you want one. But most of them have these things online. Or you can go to the SEC, the Securities and Exchange Commission, and pull up what's called a Form 10-K, which is the annual report. The problem is the difference between the annual report that you get from the company and the Form 10-K is that the company's annual report is nice, with pictures, and you know, nicely bound and everything, and the 10-K form that you get is about 150 sheets of paper that are all over the place. Now that's the information is the same. Now, but it's much more difficult to find in the SEC filing. But you can get everything that has to be filed with the SEC is publicly available. Every form that a company has to file, 10-K is the annual report. There's also something called a 10-Q, which is a quarterly report. Every company has to file a quarterly and an annual report. And they're all publicly available at their website. Analyst reports, you might have a broker, or you have a brokerage account. Your brokerage firm normally employs analysts, or they get third-party analyst reports that you can actually access. So these are people that look at the company, analyze the company, and will tell you about what they think. Then there's Value Line. We do have Value Line in the library. Now there's a Value Line that looks at about 3,000 companies, 1,700, it comes to 3,000 securities overall. But what they do is every week there's a new one coming out, and they update 1/13 of the 1,700 reports that they have in there. They update, so throughout the quarter, every company's report is going to get updated at least once. And there will tell you give you some basic information. It's just a one-page thing, a nice summary of all the information that you might want to know about the company, including all these things that I showed you on the previous slide. Standard & Poor's, we have those in the library too. They do effectively the same thing, just a different company. Mergent publications, it used to be Moody's Investor Service, they do the same thing. Financial newspapers. You can read the Wall Street Journal. There's a lot of stuff in the Wall Street Journal. A lot about rumors and things like that. Barron's, Investors Business Daily is a very popular periodical for that too. All of these things give you information, and then you go online. Yahoo Finance, Google Finance, great resources on there, and they're all free. Now you can go on there and you can research companies. Now you don't get any analyst reports there for free. They do give you links to analyst reports, which you then can purchase if you wanted to. But they give you nice snapshots of the company that you can look up historical stock performance. You could look up certain ratios and things like that. And they're directed to the website of the company and where to find the annual reports and all those kind of things. So they're very easy to find. It's very easy to find things on there when you go to Yahoo Finance, which I like, but Google Finance is very good too. Microsoft has a finance, MSN has a finance website too. But I find Yahoo Finance and Google Finance are very good also in providing historical information and so on and so forth. But there's tons of stuff on the world, on the internet about companies. And a lot of that stuff is free. And again, a lot of the stuff we have here in the library. So there's a lot of information. The problem with all of that, there's a lot of information. What am I going to do with all that information? How do I interpret that? And that's why I would say it's very difficult to do. You basically need a degree just to figure that all out. And that's why you want to rely on. You've always be very careful. First of all, with analyst reports, you have to be very careful to make sure that where the interests lie. Now, they're supposed to be separate from the companies that trade the stock and so on and so forth, but there is some conflict of interest for some companies. And it's been shown before that an analyst would actually would recommend a stock, and then it turns out that internally that analyst didn't like the stock at all, but publicly they recommend the stock because the company would also serve as an underwriter for this company. So if I say something bad about this company, then that company is not going to do any business with me anymore. They're going to find somebody else to underwrite their securities. And there is a strong conflict of interest there. And there have been prominent investment banks that have been fined by the SEC and FINRA for doing things like that. So there's a conflict of interest. Now, the CFI Society, which are the ones that give out the Chartered Financial Analyst charter. Now this is most financial analysts, if they're at least the ones that want to make some good money and work for portfolio, for investment funds and so on and so forth, they have a CFA charter. Now, so they're certified financial analysts. The CFA Institute kind of tries to monitor these things and make sure that with anybody who actually gets in trouble with conflict of interest is going to get their charter removed and things like that. But there's still always, something. There will always be a conflict of interest. The more, like a value line, for example, Standard & Poor's, they're not investors. They do not run mutual funds. They do not run underwriting businesses. Their business is to analyze companies. So their conflict of interest is a lot lower. Their level of objectivity is a lot higher than if I were to look at an analyst report from Goldman Sachs, for example. The level of objectivity is not quite as high there as it would be with Value Line or Standard & Poor's. That doesn't mean they're doing a bad job, but you're going to have to look at that report in context of if they do any business with that company. Now, when do I sell the stock? Well, when the fundamentals change. Otherwise, I buy stock because I think it's a good company. At least hopefully that's why I buy the stock. There are people that buy stock because they like the colors of the company or they like the name of the company. There's all kinds of crazy reasons why people buy stock. The Green Bay Packers just issued stock just last week or this week. They issued 290,000 shares. They raised like $600-something million within like a day. That stock does not carry a voting right, does not pay a dividend, and is not traded anywhere. But people bought it like it's going out of style. And it is because everybody in Wisconsin wants to be a shareholder of the Green Bay Packers. That's why, and they want to frame that, and hang it in their den and say, look, I'm a shareholder of the Green Bay Packers. I guess that's a good reason to buy a stock, but it's not an investment. Because you will have a very hard time actually selling that stock. But then again, most of the people that buy that stock would never even think about selling it again. But, but you do normally analysis of the company. What are the fundamentals? What is the line of business? What are their sales? How are they doing? What is the future of that company? Is there a strong industry? Are their products good? And so on and so forth. Those are the things that you want to look at. If any of this changes to the worse, not to the better, but to the worse, you want to get rid of that stock. Because if the fundamentals go bad, the value of the firm goes bad, and that's going to be reflected in the stock price. And this whole thing about, well, I'm just going to hold on to it and it's just going to turn around, that's not a good policy. That never. Now, if it's something like we had in 2008, where the whole market tanked, that's a different story. But if one particular company is in some trouble, you've made money in that stock, you sell that stock. Now, if you think once a company reaches its bottom, then it's going to go back up, there's no reason why you can't reinvest your money in that company. But you want to first realize your gains if something like that happens. The dividend is cut. There's no worse signal for a company than when a company cuts its dividends. Because that means they don't have any money to pay to you. And that's a last resort. Companies do not cut dividends unless there's something bad happening. Plus, the dividend is one reason why people buy stock. So the value of the stock, one of the determinants of value of the stock is how much dividend the company pays. If I cut those payments, that means the value that I receive from buying the stock decreases, meaning I'm not willing to pay as much for it as I was before, so the stock price is going to drop. And it's not going to come back up unless the company increases their dividends again. And again, a company will never actually decrease their dividends unless they really, really have to. It's a really bad signal. If you see a company, and there's tons of empirical studies about that, and you just watch the market, what happens to the stock price when a company announces a cut in dividends. There's a huge drop in the stock price. So that's not a good thing. You reach your target price. That's where it gets very difficult. Not so much because you don't know what your target price is. As you actually read analyst reports, they will tell you what they think the value of the stock is going to be in a year or two. But then saying, okay, well, it has reached the target price, but I think it can go higher than this. And it might very well. It might very well. But it also could reach its target, and it might go back down. So again, realize your gains. That's what you do. Nobody says you cannot reinvest in the stock. But realize, you know, how much do you reinvest? And it's very difficult to do. It is very difficult to do this, that you say, okay, I made all this money. Now, one of the things that you can do is, for example, say, okay, I set a target price. If then the stock price drops like 5% below the target, I'm going to sell. And if it goes, otherwise, I'm going to just keep the stock. So if I see it drop back down, then I'm going to sell. So I'm going to give me some sort of cushion. So I don't get, oh, the target was $20, it's at $20, let's sell it. Maybe it's on its way up. So I'm just going to say, okay, if it goes down back to 19, I'm going to sell it. Now that will be a strategy. But the thing about investing in stock is you need to stick to your strategy. The moment you make exceptions, you get yourself in all kinds of trouble. When you calculate the return on your stock investment, always remember that the dividends are part of your return. It's not just by how much the stock goes up. It's also how much you get in dividends. The stock price might not go up much, but at the same time you might have gotten $5 a share every year in dividends. And another stock did not go up, went up by $5 in share price, but never paid you any dividends. The return might be the same. So you have to be very careful. The return on your stock investment is two things. It's the dividends that you get, and that the increase in the price. Now it depends on what you're interested in. Some people don't want dividends. They just want to get an increase in the value of the company. Some people want the income, so they're not so much worried about a capital appreciation. They buy the stock with high dividends. There is a stock for every investor. Always remember, the investors pick the stock. It's not that the company picks the investors. You pick a company that you think is a good company that will perform for you. And that's how that makes it. There is a good investment for every company. Now, for every investment. Now, if the company changes something, that might not be what you want anymore, and then you want to get out of this. If the company is a growth stock and then turns into an income stock, that might not be the stock that you want anymore, and you're going to sell the stock and find yourself another growth stock. Now, that depends on your objective. Every investor needs to have an investment objective. Acting on tips. Not a good idea. You overhear somebody say something about this company or that company. Or, you get the emails. We're going to have a whole session on about those emails that you get, about investment opportunities. Getting sentimental. I worked for this company for 30 years. I don't want to sell that stock. Well, there's a lot of people that work for GM for a long time. I hope they sold all their stock. I really do. Because if they didn't, they lost a lot of money. It's just something where you have to take the sentiments out of investments. It just doesn't work. You can't say, well, I really like that CEO. No, he's such a nice person. It doesn't do anything for you. If the stock does not perform, remember why you're investing in the stock. You're not investing in the stock as a personal favor of the CEO, and you're not investing in the stock. You might have worked for GM for 30 years, and that's how you ended up with all that stock. But if the company turns around and it doesn't do very well anymore, you're the one that's going to be hurt. They're not going to say, well, we're so sorry for our shareholders that all lost their money. We're just all going to give them some money. It's not going to happen. So you cannot be sentimental about the stock. You cannot buy stock because, again, you go in the mall and you say, well, this store smells really nice, so maybe I should buy that stock. Or I like the symbol of that company. Or I really like the commercial. That's not why you buy stock. Unfortunately, people do buy stock because of that. They do buy stock that way. Or this is a company I grew up with. I bought their products when I was growing up. I haven't really seen them, but I really liked those products when I grew up, so I should buy some stock in that company. Maybe there's a reason why you didn't see the products for a while. So it's just those kind of things you have to avoid. You have to be very objective when you do an equity analysis. You're looking at the numbers. It's all about number crunching. That's what equity analysis is all about. It's nothing else in there. It's all about number crunching. Do the numbers tell the story? And do they tell a story that you like? If they don't tell a story that you do not like, if they do not tell a story you like, then do not invest in that company. There should be no other reason why you invest in a company. Forgetting taxes and commissions. You do have to pay taxes. You do have to pay commissions. When you buy stock, you have to pay a commission. When you sell stock, you have to pay a commission. Depending on who you work with, some brokerage firms charge you more, some charge you less. And when I talked about mutual funds, I talked about the fact that you can actually buy mutual funds without paying any commission. They all have transaction cost-free funds, a whole bunch of them. You're not that lucky with stock. You are going to pay. You're going to pay something. That might be as little as $1.95. It might be as much as $14.95 or $19.95. Or if you actually call somebody, it might be as much as $24.95 or even more than that. But you have to think about it. If you pay, and then sometimes it's a percentage of what you buy. Now, sometimes it's a fixed fee, sometimes it's a percentage. Sometimes it might be, okay, your commission is 1% of the total purchase price. Now think about it. If you pay 1% of the total purchase price, and then you have to pay another percent of the total sales price when you sell it, because commission is paid on both sides, that means your stock has to go up at least 2% before you even break even. You can never forget that. Now you're better off with a flat fee if you buy in large quantities. If you pay $9.95 for a stock investment, you buy $10,000 worth of stock, $9.95 isn't that much. But if you pay $9.95 for your commission and you buy $100 worth of stock, that's 10%. So that's the problem with flat fees. They might not look much, so if it is $9.95, that's a reasonable commission. But when you make investments, don't invest $50 at a time, because that's going to be expensive. You're going to have to, you're going to have to go in even if you build $1,000, that's still 1%. That's still 1% back and forth. That's 2%. So never forget that, and you have to pay taxes. You have to pay taxes on dividend income. You have to pay taxes on capital gains. Now you do pay a lot less in capital gains than you pay on income tax. The capital gains tax is a flat tax. It's at like 15%, I believe. Flat tax. Doesn't matter if your capital gain is $1 or if your capital gain is $1 billion. It's the same tax. It's different for income. Dividend income used to be taxed as a personal income. It's not taxed at the personal income tax rate at this moment. But again, these are tax laws. They can change. They're not written in stone. Tax laws change all the time. So got to keep that in mind. Failing to diversify. Don't put all your eggs in one basket. Don't just buy stock in one company. Because if that company goes bad, your entire investment is gone. Now, you're going to have to diversify across different companies, across different industries. Don't put all your money in bank stock. Now, diversify. Don't put all your money in technology stock. Diversify. Diversify it across different industries. Losing patience. The problem is you can lose a fortune overnight. You're most likely not going to make one overnight. That's unfortunately the way it works. The stock market is a long-term proposition. You had invested $1 in the stock market in 1925. You would have over $1,000, and that's inflation adjusted, today. That's inflation adjusted, meaning your purchasing power of your dollar now would be $1,000. If you had held that investment for 90 years. It takes sometimes, it takes a little while. The faster your stock price is going to go up, the greater is the chance that it's also going to go down very quickly. Because there's always a reason for these things. There's always a reason. But at the same time, you're looking at if you had invested in Microsoft stock 25 years ago, you would have made a fortune. Everybody who has worked at Microsoft for the last 20 years is a millionaire. It doesn't matter in which position you work. If you're the person at the receptionist, or if you're the CEO. Well, CEO actually is a billionaire, but if you're anybody at that company who's been there long enough is a millionaire today because they got bonuses in stock. They didn't pay out cash bonuses. They paid out stock bonuses. If you were smart enough to hold on to those, you would have made a lot of money. Now that's not quite true anymore now because Microsoft is not doing so well. But the same thing, if you had worked for Apple for the last 20 years, it would be the same thing. If you had started in Apple in the mid-90s where the company was almost bankrupt, and today, Apple, as of today's stock market, Apple was the largest company, most valuable company in the world. Now, in terms of market capitalization, which is the stock price times the number of shares outstanding. In other words, if you wanted to buy all the shares of the company, there's no company in this world that is more expensive than Apple. Or in other words, more valuable than Apple. As of today. Now it changes, sometimes it's Microsoft, sometimes it's Exxon, but today it was Apple. And 20 years ago, in the mid-90s, Apple was about this close to going under. Apple was a niche company. A niche company. Nobody was using Apple computers anymore other than graphic designers and sound engineers. Those are the only people that were using Macintosh computers or Apple computers at the time. Look at the company today. It's an amazing turnaround that company has taken. But if you had lost patience with that, so if it didn't quite work at first, you would have lost out a lot of money. Investing means not losing sleep over your portfolio. Now that doesn't mean that you never should look at it because you need to keep an eye on the companies that you invested in. If something bad happens to the company, you need to get rid of that stock. As I said, and the fundamentals change, you need to get rid of that stock. But if the company just performs slowly, there's no reason to panic. Stock investment is a long-term investment. If you need money tomorrow, you shouldn't invest in the stock market today. That's not, if you're retired, you shouldn't put your retirement money in the stock market. You should put them in what we talk about next, in the bond market. But if you have 20 years or 10 years until you retire, yes, you want to put some money in the stock market. You're going to make some money over that time. You just have to be patient. And then do not buy penny and micro-cap stock. Again, there's a reason why the stock is so cheap. Penny stock, officially a stock trading with less than $5 a share. The New York Stock Exchange will list every company that trades under $5 a share, meaning you cannot have a stock listed in the New York Stock Exchange that trades under $5 a share. That's why some companies have to do something to kind of manipulate their stock price, especially a lot of the Citicorps of the world, to not get dropped from the New York Stock Exchange, because their stock was trading at like $3 and $2 and $1 at a time. So you kind of have to bring the stock up, which you do by buying back a lot of stock and making the number of shares outstanding smaller. So stay away from those. These are purely speculative. These are speculative investments. And again, that's actually that's a contradiction in terms, speculative investment. It is, you're either speculative or you're investing. You cannot do both at the same time. So these are the stocks. Bonds. So it's a traded loan. It's a publicly traded loan. A bond is a loan. Whoever issues a bond needs a loan from you. Meaning you're going to get an interest payment, and then when the loan matures, you're going to get the principal back. So a bond is an interest-only loan. It doesn't make any amortization. There's no amortization payments to the bondholders during the life of the bond. The company might make amortization payments into what's called a sinking fund, but they're not paying them to you. They put them aside so that when the bond matures, they can actually pay back the principal to all the investors. There are called income securities or fixed income securities. You know what you're going to get. Always assuming that the bond is actually going to stay alive, or the company is going to stay alive throughout the life of the loan, just like any other loan. If I'm a bank and I make a loan, I make it under the assumption that whoever I gave the loan to is actually going to be able to pay back to me in its entirety. And as a bondholder, I have to make the same assumption, or at least I need to do my research and do my homework to make sure that that happens. Some interest income is tax exempt, particularly municipal securities. If you buy a municipal bond, you do not have to pay taxes, federal income tax, on those bonds, on that income that you generate. They can have maturities up to 30 years. There are actually bonds out there that have 40 years. There was a time when companies were actually able to issue 100-year bonds. To be honest with you, there's no reason for anybody as an individual to invest their money into a 100-year bond, into a 40-year bond, or even into a 30-year bond. There's no reason for that. And we'll get to that in a minute why that is so. The face values typically range between $1,000 and $5,000 a share or a bond. That's a big difference between the bond market and the stock market. Stock markets trade at a very low price per share normally. There's actually something that we call what we call a common trading range or popular trading range for stocks is somewhere between $15 and $45 a share. Now you see companies where the stock price goes up to $500 or $600 a share, and then they're going to split their stock. Meaning that they're going to give you 2 shares for every share that you've held, or 3 shares for every share that you have. That means you're splitting the stock price by 3. Because now, before you had 1 share that was worth $500, now you have 5 shares that are worth $500, which means that 1 share now is only worth $100. That's how I can bring my stock price down if it gets too high. And that's why companies split stocks. Because from a financial point of view, for me as a finance person, it doesn't make any difference if I have 1 stock that is worth $500 or if I have 10 shares that are worth $50 each. It doesn't make a difference. However, behavioral finance tells us that the individual investor, it makes a huge difference. If it's 1 share, it's $50 a share, or 1 share at $500 a share. It makes a difference if I have 10 shares that are worth $500 versus having 1 share that's worth $500. That's why Warren Buffett doesn't split the stock of his company. Because he doesn't want just anybody to buy his stock, in particular not buying it and selling it all the time. That's why it's trading at $1 million. That's it's the most expensive stock in the stock market. It's never split, and because he doesn't want to split, he wants to. Actually, it's not a million. I forget it was. It's not $1 million, but it's. I think it's 90. It's one to zero. It's like $99,000 or something. A share, just one share. What he wants to do by that is he only wants serious investors. He doesn't want people that speculate with his stock. Because you need to be fairly serious before you dish out $100,000 for one share of stock. And that's why he doesn't split. Now bonds come in $1,000 and $5,000 face values. You have to buy a bond at $1,000 or $5,000 face value. If you do not have that kind of money, you cannot actually buy a bond. Then what you should buy is a bond fund. Things that we talked about last week. That's why particularly for bond investments, funds are much better for an investor than buying the actual security. The other problem with bonds are that they're traded over the counter. There is no exchange for the bonds. You know, there's a NASDAQ, there's a New York Stock Exchange, and all kinds of other stock exchanges out there where stocks are traded, where buyers and sellers come together and trade. There's no exchange for the bond market. It's an over-the-counter market. What that means is, if you want to buy a bond, you're going to have to call your broker. And then your broker is going to call, or they don't call anymore. They just post it on the computer. They go to their trading screen, and that's put in there, I want to buy one bond of GE. They're going to tell you exactly which bond it is. And then there's going to be people in the market that say, okay, I'm going to sell it to you at this price, at this price, at this price, at this price. And then the broker is going to pick the best price, at least it's supposed to, pick the best price, and that's the price that you're going to pay. That's how it works. Somebody else might call the broker 5 minutes later, or at the same time for that matter, and want to buy that same bond and pay a completely different price for it. And the other thing is, it's not very easy to trace the prices. See, in the stock market, you turn on the television during the day. If it is CNN or CNBC or any of the news channels, you have a stock ticker drawing on the bottom of the screen, where you see all these different stock quotes. And we know them because they're traded on the exchange, and every trade needs to be recorded. By law, every trade that happens in the stock exchange, any stock exchange in this country, needs to be recorded. How many shares, for which price, and who are the parties involved. So every time a price is being quoted, that price is going to show up on the big board. And 15 minutes later, it's going to show up on the bottom of the screen on television. It's 15 minutes because it's proprietary information for the first 15. See, the New York Stock Exchange and NASDAQ and all these places, they want to make money. They are for-profit organizations. Now, New York Stock Exchange is a publicly traded company. And they need to make money. How do they make money? Well, they're selling the real-time stock price information to all the people that need real-time information. After 15 minutes, it becomes public domain. So they have to give it out for free after 15 minutes. That's why it says on those tickers on the bottom, stock price is delayed 15 or 20 minutes. That's not because they don't have the technology to give you real-time quotes, they just don't want to pay for the real-time quotes. That's the reason why the stock prices on the bottom of your screen are delayed. However, you can go by now on the internet to places like Yahoo Finance, for example. They will actually give you real-time stock prices. As long as you don't mind all the ads all over the page, that's why you're getting real-time prices, but they will give you real-time stock prices. But on television, they are delayed. But the bond market, it is virtually impossible to find a bond price. Now, for corporate bonds, there is a system called TRACE, where they're actually required by FINRA, one of our sponsors here, to actually record every bond transaction. But it's still not that publicly available. You cannot go to the internet and just find it. If you had like a terminal, like a Bloomberg terminal, which cost about $20,000 a year, if you had access to this, you could look up a bond price, and the only reason why Bloomberg has that price is because Bloomberg has an arrangement with a bond dealer who will give them a price every time they ask. That's how Bloomberg has a price. There is no source where they can just get all the bond prices from. That's the problem with the bond market. There's very little transparency in the bond market. The bond dealers, they all know each other, and they know the prices, and they call each other, and they have all this information. As an individual, it is very, very difficult, if not impossible, unless I want to spend a lot of money, to get that information. And that's the problem with the bond market. That's the problem of the over-the-counter nature of that market. It's a face-to-face transaction that you have in the bond market. You buy it directly from the person who's selling it to you. There's no middle person, there's no, like in the New York Stock Exchange, there's what's called a specialist that's in between the buyer and the seller, that brings the buyers and the sellers together. There's no such thing in the bond market. So that's what makes the bond market very different. What kind of bonds do we have? Secured bonds. Unsecured bond. The secured bond is a bond where there's some sort of collateral pledged against it, which means that if the company were to default on the bond and were to go into bankruptcy, you have the right to get that collateral. At least that's how it's written on paper. And so far that's always been true, except for one situation. There was a GM bankruptcy where all bondholders were treated the same way. It didn't matter if you had a secured or unsecured claim, you were all treated the same. That's a precedent that had never happened before, hasn't happened since, but that was a very, very unique situation. Unsecured means that you do not have any collateral pledge, meaning if the company goes bankrupt, your money comes out of a big pot. And there is a priority rule in terms of claims, who gets money first, second, third, and so on and so forth when a company gets liquidated. As you might have imagined, the lawyers and the government get money first. In a bankruptcy procedure, all the lawyers, attorneys, and court fees need to be paid first. Then all the outstanding taxes need to be paid. Then a lot of the employee benefits, not all of them, but a lot of them need to be paid out first. And then the bondholders are going to get their money. So they're already very down on that list. It's called an absolute priority rule. And then the shareholders, by the way, are the very last one on that list. The common shareholders are all the way on the bottom. There's nobody after the common shareholders. That's why they normally don't get anything. Zero coupon bonds are bonds that do not pay a coupon, pay not any interest, where you buy them at a very low price, and then when the bond matures, you get the full face value. And the money that you make on that is the difference between what you paid for it and what you're going to get back. Most short-term bonds, like treasury bills, for example, would are zero coupon bonds. Corporate bonds are bonds issued by corporations. Municipal bonds are bonds issued by state and local governments. They obviously have, as we know, bankruptcy risk. There is default risk on those bonds. Treasury bonds are considered risk-free. They are issued by the US Treasury. There's no risk associated with those because the Treasury has never defaulted, ever. In the history of this country, the US Treasury has never defaulted on its obligations. Agency securities are securities issued by other government agencies. So they're not issued by the US Treasury, but they might be issued by the VA, for example, or the FHA, the Federal Housing Agency. They issue securities. Those are government agencies, meaning they're backed by the full taxing power and credit and faith of the government. So they're almost as risk-free as treasury securities are. They're not 100% risk-free because the government could always change its mind and get rid of those agencies. That is always possible. They're not going to get rid of the treasury. So, because that's money that the government actually uses. So that's the little difference there. US savings bonds, and we talked about those before, they're issued by the Treasury as well. That's a different kind of bond that you can invest in. It's also a safe investment. There's no risk involved with that. Callable bonds are bonds that can be called at any time, meaning that you might have bought a bond with a 10-year maturity, so you're thinking you're going to get a coupon payment normally every 6 months for the next 10 years, and then you're going to get your money back 10 years from now. Now, interest rates might go down in the market, and when interest rates go down, most of us refinance loans that we have. So do corporations. So they have a bond outstanding that pays 6% coupon, and say, you know, now I can get it for 4, so I'm going to call that bond. So I'm going to give you back your money, and then I'm going to issue a new one at a lower interest rate. They can do that if the bond has a call feature. And you wouldn't know about it because they have to tell you that. You know, it has a call feature. If it has a call feature, it can be called by the issuer. If it is a convertible bond, you can convert, as an investor, you can convert that bond into equity. In other words, instead of getting the principal back, You just say, well, don't give me my $1,000 back per bond, just give me shares of your company. Now, how many shares you get, that is predetermined. When you buy the bond, you know how many shares you get. It makes sense to convert the bond if the value of the shares that you're actually going to get is greater than the face value of the bond. If the bond would give you $1,000 when it matures, but you can convert it into stock, and the stock is worth $5,000, obviously it makes perfect sense to convert the bond into stock. But you do not have to do it. It's not required. It's an option that you have. And a lot of small companies do that, a lot of startup companies do that because it brings their cost of debt down, makes it cheaper for them to actually issue bonds. They don't have to put a high interest rate on that bond that way. Bond yield. It's a lot of different things. If you look up a bond, and these, at least Standard & Poor's and Moody's, they also have bond manuals, so they will tell you about bonds. You can look up bonds in the Wall Street Journal, not a lot of them. You can look up bonds on the FINRA website. FINRA.org is the website. Again, that's also the sponsor of this series, and they will give you yields on bonds. Now they're going to give you different kind of yields. They're coupon yields, current yields, yield to maturity, all different things. First of all, we need to understand that bonds are fixed income securities and they're driven by interest rates. And there's a relationship in that bonds prices go down when interest rates go up. And bond prices go up when interest rates go down. There's an adverse relationship between the two. They move in opposite directions. That's very important to know. Because when I'm in an interest environment like I'm right now, where interest rates only have one way to go, which is up, if I buy a bond today, and if I do not plan on holding that bond to maturity, but I'm planning on selling that bond at some point, maybe I'm thinking about capital appreciation, that bond is going to lose value. Because the moment interest rates go up, the bond price is going to go down. There's no question about that. That is absolute certainty. So that's why you should never buy bonds in a low interest rate environment. At least not any long-term bonds. The other thing is, the longer the maturity in the bond, the more severe is that change in price for a change in interest rates. So a 30-year bond is going to move much more in price when interest rates change than a 60-day bond or 60-day bill. Now, different things. Coupon yield or coupon rate is the rate that you say when it says this is an 8% bond. That means that the coupon rate is 8% of face value. The face value normally being $1,000, which means that this bond is going to pay you $80 in interest every year, which is split over 2 payments of $40 every 6 months. That's what a coupon yield means. It's just the return relative to the face value. It is nothing other than the interest that you have on a loan. Now, I'm going to pay, again, an 8% interest on a bond means it's 8%, or 8% coupon means it's 8% of the face value. The current yield, which is very often quoted, it's one of the most misleading figures there is when it comes to bonds, but somehow it's always quoted, is the yield relative to the current price. So if I get a bond that pays a $90 coupon payment, and I buy it and it's worth $900 right now, then the current yield would be 10%. $90 of 900 is 10%. Now a bond that makes a $90 coupon payment is a 9% coupon yield bond, but it would have a current yield of 10% because the current yield is based on the price, not based on the face value. Now, all that tells you is kind of like the dividend yield on a stock. What is the income that I generate relative to the price that I pay for it? That's what the current yield tells you. It does not take into consideration the fact that when the bond matures, you're actually not going to get $900, but you're going to get $1,000. It does not take that into consideration. All it does is telling you, if I buy a bond today at $900 that pays me a $90 interest payment, that has a current yield of 10%. That is all it tells me, and it means nothing in terms of overall return on my investment. Where I get a better idea of what I'm actually going to make on that bond, if I hold it all the way to maturity, is the yield to maturity. And that's what's going to be quoted first and foremost to you in the bond market, is the yield to maturity. So if I buy a bond today that has a 9% yield to maturity, that means that if I hold this bond to maturity, and it makes all its coupon payments or its interest payments as promised, when they are promised, I will have realized a 9% return on my investment over the life of the bond, regardless of what happens in the bond market. Because that's the thing, if the bond prices, if the price of the bond goes up or down, it doesn't make any difference to me, because unless I sell it. Because my coupon payment is not based on the price of the bond. My coupon payment is based on the face value of the bond. So this is a 9% coupon bond. I'm going to get 9% of $1,000 every year, as long as that bond exists, regardless of what the value, what the actual market price of the bond is. Because if interest rates go up, for example, during that time when I own the bond, the market price of the bond is going to go down. It will go down, but it has no impact on my coupon payment, on the interest payment that I'm going to get. If you think about it in terms of something maybe closer to everybody, if you have a mortgage, the mortgage payment that you make every month is absolutely independent of the value of your house. Now, the value of your home changes, and obviously it has changed dramatically over the last 4 years. Your mortgage payment didn't change, and because your mortgage payment is not based upon the value of the home, but how much money you borrowed, not how much the home is worth. And the same is true for the bond. The coupon payment that you get is based on how much money you actually gave to that company, which is normally $1,000 per bond. So the coupon payment does not change. The coupon yield does not change over time. So the yield takes it into consideration. Yield to maturity takes it into consideration. Just says, okay, you're going to get that coupon payment every 6 months, and then you're going to get $1,000 when the bond matures. All of that, relative to what you paid for the bond when you bought it, going to give you the overall return on your investment. That's what the yield to maturity is. So that's what the most important piece of information that you want to look at when you look at a bond. What is the actual yield to maturity that bond is going to give me? If you're in the market, again, for investment, for income purposes, there's not a lot of people that know the bond market very well, and that's why not so many people should be in the bond market trying to make money based on capital gains. You can make and lose as much money in the bond market as you can in the stock market, believe it or not. And by the way, the volume of the bond market is about 10 times the volume of the stock market. The bond market, as far as a financial instrument, as financial market in this country, is 10 times more important than the stock market. It's just everybody talks about the stock market because we know everything about it. We know nothing about the bond market. But from a financial point of view, bond market is much, much more important.